Welcome back to Investing Talk Podcast.
Today we're looking at Shoals Technologies Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Right. Shoals is a fascinating one. It's a real tug of war for investors.
Yeah.
On one hand, you've got this huge proprietary advantage and massive growth potential.
But on the other, you've got some pretty serious sector headwinds and some legal and operational risks we need to talk about.
Exactly. So our mission today is to kind of cut through that noise. Is this a buy on the dip situation, or are those risks just too heavy?
Well, whenever we look at a growth stock, the first place to start is the moat, the competitive advantage. And for Shoals, that moat is all about simplifying a really, really complicated part of building a solar farm. It's called the electrical balance of systems, or EBOS.
Okay, let's unpack that term, EBOS. It sounds super technical, but it's basically the solar farm's circulatory system, right?
That's a great way to put it. It's all the wiring, the connectors, the harnesses, fuses, safety stuff, everything that connects the panels to the grid.
And traditionally, that whole process is just a mess.
Yeah.
It's fragmented and takes a ton of manual labor.
Precisely the problem Shoals solved. See, they don't just sell you a box of parts. They sell integrated, factory prefabricated systems. They're plug and play.
Plug and play, so you mean they just click together on site?
That's the idea. You're not dealing with miles of wire spools. You get these fully bundled systems ready to go. They're big lead assemblies, or BLA, are sort of the key here.
The BLA, what is that exactly?
Think of it like a custom-made wire harness for that specific solar field. It replaces hundreds of individual connections with just one molded assembly. It's engineered in the factory, labeled, and ready to install.
And the number that just jumps out at me for a developer is a 50% labor cut.
It's a huge number.
I mean, how does that kind of saving change the actual economics of building one of these massive projects?
Well, labor is the biggest wild card in construction, right? It can fluctuate wildly. So by cutting that labor time, sometimes by half, you shrink the whole construction timeline.
Which means the project starts making money sooner.
Exactly. So the value isn't just the cost of wire. It's the time, the reduced complexity, fewer mistakes in the field.
And that explains the high switching costs.
Yeah.
I mean, once you've built your whole operating model around 50% labor efficiency, you can't really go back to the old way.
You can't. And that's what's made them the largest global EVO supplier. They're just perfectly positioned to capture this accelerating demand. We're talking about global deployments exceeding 66 gigawatts.
66 gigawatts. That's an immense amount of capacity. It's a really compelling story, especially with the global push for electrification.
It is. But we have to pivot to the financial reality. The recent numbers, they tell a bit of a different story.
Right, the headwinds.
Yeah. We have to acknowledge the 2024 revenue. It came in at $399.21 million, which was an 18.35% decline year over year.
Oof. An 18% drop is definitely a speed bump. And it explains why the stock's been under so much pressure.
It does.
But the whole bull case, it hinges on the future. I'm seeing forecasts for 39% annual earnings growth over the next 3 years. That's staggering. How is that justified after such a steep decline?
Well, a few things. First, that growth is relative to that recent dip. The market is basically seeing that 18% decline as temporary.
So caused by things like supply chain issues, high interest rates, stalling projects, sort of thing.
Exactly. As those macro problems stabilize, the expectation is for a big margin recovery. And 39% growth, I mean, that blows the general market expectation of, 11% out of the water?
So it's a bet on a massive reversion plus acceleration.
It is. And the second driver is revenue diversification, which we can get into. But just as important, the company seems financially sound enough to weather this storm. Their debt-to-equity ratio is only 0.22.
That's very low. So that's their safety net, really. When your revenue drops 18%, you don't want to be forced to raise cash at a bad time.
Precisely. And they're using their cash reserves for R&D and manufacturing expansion, mostly in Tennessee and Alabama.
A strategic move, I'd imagine, focusing on domestic manufacturing.
It is. It makes them less reliant on volatile global supply chains. It actually strengthens the moat.
Okay, let's shift to the stock itself. That resilience you just mentioned, we kind of saw it in the recent price action, didn't we?
We did. It's a fascinating technical setup. The stock had a brutal month, down 29%, but then it surged 6.6% to 862 on really strong volume.
So that 29% slump basically priced in all the bad news we've been talking about.
I think so, yeah. And the rebound is important because the stock is starting to form higher lows. That tells you buyers are starting to step back in.
But even with that, we have to talk about valuation. The PE ratios is high, somewhere between, 37 and 45 times earnings. Why should an investor pay that kind of premium?
It's the classic growth stock dilemma, isn't it? You're paying a premium because you're buying future growth, not today's earnings. You have to connect that high PE back to the 39% growth outlook.
A company expected to grow that fast is always going to command a premium,
It will. And we're seeing some support for it. The recent quarterly results actually beat revenue estimates.
which led to analysts bumping up their price targets, right?
That's right. Targets are now averaging around $8.84. And maybe more importantly, you're seeing institutional money stick with the long-term story.
Can you give us an example of that? Because usually when a stock drops nearly 30%,
Yeah.
big players get scared and run.
Here, we saw kind of the opposite. You had firms like Financial Enhancement Group buying over, I think it was 112,000 shares.
Wow.
Yeah, that's about $832,000. That kind of cluster buying tells you that the institutional money saw that price drop as a sale.
A clearance sale. They still believe in the moat.
They still believe in the moat.
Okay, so we have the moat, a resilient balance sheet, and that huge growth forecast.
Yeah.
But what's keeping sentiment mixed? Why isn't it purely bullish?
This is where we have to look at what caused that slump in the first place. The first major risk is the ongoing legal probes. You're seeing investigations from firms like Helper Seda LLC looking into board duties, disclosures, that kind of thing. And while they might not amount to anything, that legal overhang, it creates uncertainty.
And uncertainty spooks the market. Plus, it could lead to settlements, which costs real money.
A real drag, yeah. Then there are the operational risks that hit the balance sheet directly. You mentioned the warranty issues earlier.
Right.
The margin compression and those warranty costs. I mean, the cash they had to spend on warranty remediation was a huge driver of that 29% price drop. They were basically spending emergency money to fix product issues in the field.
So the market has already punished them for that pain. The question now is this a temporary hiccup from scaling too fast, or is it something fundamentally wrong with the tech?
Well, management is assuring everyone it's the former. They're promising a turnaround through factory efficiencies. And this is where that low debt ratio comes back in as a safety net.
It gives them the breathing room to sort out these operational messes,
Exactly. The goal is just to get back to consistent free cash flow generation.
which, for our listeners, just means they need to stop spending emergency cash on repairs and start making real profit they can reinvest for growth.
That's it. Once they solve this, that cash flow should return, and it'll help prove out that high growth forecast.
Okay, so the timeline is critical here. What are the key catalysts? What should we be watching for on the calendar?
The big one is early March 2026. That's when we expect Q4 2025 earnings. And the single most important thing to watch for is a margin inflection.
Margin inflection. So you mean the point where their costs start shrinking relative to their revenue, proving the fixes are working?
Exactly. We need to see hard evidence that the warranty issues are resolved and that those new factories in Tennessee and Alabama are actually making them more profitable. If they hit those marks, that 39% growth number starts to look very real.
And the macro environment seems to be helping. You've got sector rotation back into renewables, IRA policy support.
The tailwinds are strong, and their low debt profile is a huge advantage. If the Fed cuts rates, that lowers borrowing costs for their customers, the developers.
More projects get the green light, which means more demand for Shoals.
Directly. And finally, let's talk about diversification, the speculative part of this story.
Right, you mentioned this earlier, moving beyond just traditional solar.
We've been hearing whispers, and they are unconfirmed, but whispers of partnerships for utility-scale energy storage and also EV charging infrastructure.
Wow, EV charging would be a huge move.
It would be massive. Both of those markets need incredibly complex, reliable electrical systems. It plays right into Shoals' expertise.
And it would be a true game changer for revenue diversification, if they can confirm that, especially around the EV space.
Keep a close eye out for any announcements in Q1 2026. If they can confirm that diversification at the same time they show margin inflection in their earnings, well, that 39% growth projection starts to look a lot less like speculation and more like a roadmap.
So what does this all mean for you, the investor? The core tension here is, I think, crystal clear. You have a company that's weathering a storm. It saw an 18% revenue dip.
But its foundation is built on a technological moat that's very hard to replicate. that plug-and-play system that saves developers up to 50% on labor.
It's a classic case of a high-quality growth company hitting a temporary operational snag that the market just violently priced in.
Right. And now it's positioned for a potentially massive rebound, driven by electrification, storage, and that EV diversification we talked about. This window between now and Q1 2026 is critical.
It's when they either prove the 39% growth thesis is real or they falter.
And the question for you is whether the risk of that temporary operational pain justifies the aggressive growth payoff if they execute.
That is the ultimate question. If you want to keep track of these developing stories and stay ahead of the curve, make sure you subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.